Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments, with this month's U.S. equity market chart book. I am giving my 2 cents on the chart book here that Nick has created, always creates. This month in particular, I'd like to encourage you to also look at the premium chart book, where Nick has created several new charts, thought-provoking ones. If you want to dive into depth, those are good to consider. I will go through the standard charts here and give you my 2 cents. This is this long-term valuation indicator, which is pretty much an auto regression after the sell-off in December. And please note here that this chart ends at the end of December here. They are, according to this 10-year outlook, for what it's worth, suggests that there might be a small percentage hike that's possible. Positive returns, annualized return might be possible over the next 10 years. We obviously have had a rally since, so stay tuned for an update here. Earnings backdrop looks a tad mediocre. Business cycle backdrop, many of these things, nothing terribly new to report. I think what is really new to report, what's not shown on these charts, is that if you listen to what the central bankers, for example, said at the IMF meeting last weekend, the glass is less half empty. They're starting to be a tad more confident again. Same on Chinese news, a little bit more positive. As I speak here on Monday, Volkswagen said that their Chinese sales may not be all that bad, and this is not an investment recommendation for any comic or any company for that matter. Just giving you this as a tidbit that, especially in the context here, if you look at German manufacturing PMI, that there is a German car manufacturer that says, hey, maybe things aren't all that bad. This was related to the effect of a cut in the value-added tax in China. But clearly here, this does look negative. Obviously, if you look at the Purchasing Manager Index plunging, the services PMI so is actually looking much better in Germany. But clearly the automotive sector has had some significant issues there. And part of it is technical, based on their emission standard equipment that's not up and running and ready fully. Part of it is tariffs. Part of it is the gloomy outlook on many uncertainties. But the short of it is, if you stick to what the chart says here, there are several things that are negative. Although what is positive is that China has popped back above 50. And remember, China is really the biggest elephant here. We get so caught up talking about Brexit that we forget that the Chinese economy is actually the much bigger one. Financial conditions here, according to this metric, look just fine. Obviously, in December, they had dipped down a little bit. Now, some people are saying that how you should look at the more nuanced ones, and you should look at the auto loans and whatnot. And that is certainly correct, that there has been some tensions, and we've talked about this, that emerging markets, other places have had some tensions. The weaker end of the consumer sector has had some tensions. This particular index we like because it's less subject to little things, including volatility in the stock market, and many other financial condition indices are more prone to. But depending on how much forward-looking you want to be, and maybe you should take a step back and think about, well, why are we doing this? And if we get really whacked by some downturn, we may not be able to see it in these charts. This is really an indication of how long in the tooth is the economy. Now, if there is, again, a shock, we can always fall into a recession, of course. But one of the things that we see here, first the technicals here again, technical market breadth looks actually quite good. The sentiment is at no extreme here, but reasonably positive. Margin debt, there are different ways of looking at margin debt, but looked at it in this way, it doesn't look extreme, right? And this is a particular framework. I'm not going to explain it here now, but the short of it is, again, nothing extreme, nothing too worrisome here. Policy uncertainty, the VIX curve early 2016, that was the kind of very fashionable. Basically, if we are plunging this, the forward VIX curve might be inverted. Again, I'm not going to go into that in too much detail. Technicals look decent here, and the calendar returns also look good. I wanted to show you one more thing, but I guess it's not on this chart, about the overall positive trend that we're seeing on many on many of the underlying indicators that the market breadth is really good. So the technicals in the markets are reasonably good. If you look at the FOMC, and we do obviously have our separate FOMC chart book on the Fed, there is lots of things to be positive about. This fear that the Fed had, I think it was a bit overblown. I think the Fed was whacked by the markets. And I'm talking here strictly about the business cycle. The question is, there's the saying, of course, well, if the business cycle is okay, then the stock market should be doing all right. And at the same time, of course, yep, there is, of course, the fear that we are long in the tooth on this expansion. But the excesses that one might see in the market, and again, I was leaning here into the premium chart book that you can have a look at. The excesses that we would see in the markets, and in previous bubbles, we had extremes in the housing market, extremes in the tech sector. The only extreme one sees right now, if one can call it as such, is some complacency about wage growth not spilling over into inflation. So my biggest fear, if there is such a thing in this context, is that the Fed is making policy mistakes if they are not vigilant, and that means we might have a mess on our hands if they have to then rapidly increase rates to fight off inflationary pressures if they do spill over to other areas. So to me, that is really the concern that's out there. It's very difficult to time that. I've been arguing that we're getting close to reaching this full potential in the labor force, and if we try to pull out more, it's going to be significantly inflationary. That point, in my view, will be reached at some point. Nobody knows when that will be reached, and in my view, the Fed is way too complacent about it. But hey, that's just my thought. Anyway, I hope you enjoyed this update. Do look at the premium charts. Go to merkinvestments.com/research for additional charts on other areas, and talk to you next time.